Welcome back to Factful Finance, where we make the world of finance easier to understand and more engaging. Today, we're diving into a critical topic that many investors often overlook: the tax implications of investing, including capital gains, dividends, and tax-advantaged accounts. If you've ever wondered how your investment decisions could impact your tax bill, or how you can maximize your returns by understanding these taxes, you're in the right place. Before we jump in, a quick disclaimer. The information shared here is for educational purposes only. Listing apps or products doesn't imply endorsement, so always consult with a professional for personalized guidance. Now let's get started. Here's a fun fact. Did you know that taxes are one of the biggest factors impacting your investment returns over time? That's right. While returns on investments like stocks or bonds can look impressive on paper, taxes can significantly erode those gains. So understanding the tax implications of your investments is not just important, it's essential. Let's break it down. First, let's talk about capital gains taxes. In simple terms, a capital gain is the profit you make when you sell an investment for more than you paid for it. There are two types of capital gains: short-term and long-term. Short-term capital gains apply when you sell an investment you've held for less than a year. These gains are taxed at the same rate as your ordinary income, so they could be as high as 37% depending on your tax bracket. That's a big chunk of your profit going to the government. On the other hand, long-term capital gains apply to investments held for over a year. These are taxed at a much lower rate, typically 0%, 15%, or 20%, depending on your income. For example, if you're in a lower tax bracket, you might not pay any tax at all on long-term capital gains. If you're in a higher bracket, the tax is still significantly lower than short-term rates. This is why it's often recommended to hold on to investments for the long term, allowing your capital gains to be taxed at the lower rate. Now, let's talk about dividends. Dividends are payments made by companies to their shareholders, usually on a quarterly basis. There are two types of dividends: qualified and non-qualified. Qualified dividends are the ones that get taxed at the lower long-term capital gains rates. To qualify, you generally need to have held the stock for at least 60 days within a 121-day period surrounding the ex-dividend date. Non-qualified dividends, however, are taxed as ordinary income, which could be much higher, depending on your tax bracket. Let me give you an example to make this clearer. Meet Liam. Liam invested in a stock that pays dividends. The stock's price has been growing steadily, and the company just paid a dividend. Since Liam's income is in the lower tax bracket, he qualifies for the reduced tax rate on the dividend. He pays less in taxes and gets to keep more of his profit. Contrast that with Olivia, who is in a higher tax bracket. She's invested in a similar stock, but because her dividend is classified as non-qualified, she's taxed at the higher rate, reducing her return. As you can see, the classification of your dividends can have a major impact on your overall return. So, understanding which category your dividends fall under is critical for tax planning. Now, let's talk about tax-advantaged accounts. These are your best friend when it comes to minimizing taxes on your investments. Tax-advantaged accounts like IRAs, individual retirement accounts, and 401ks can offer significant tax benefits. With a traditional IRA, or 401k, you contribute pre-tax dollars, meaning you don't pay taxes on your investment gains until you withdraw the funds in retirement. This can be a huge benefit as it allows your investments to grow tax-deferred for years. On the flip side, Roth IRAs and Roth 401ks involve after-tax contributions, but your withdrawals in retirement are tax-free. Here's where it gets interesting. If you're investing for retirement and want to maximize your tax benefits, contributing to a Roth account could be a game changer, especially if you anticipate being in a higher tax bracket in the future. The ability to withdraw tax-free income during retirement can help you keep more of your money. Let's say Henry has been contributing to his 401k for years. Every year he gets to invest money without paying taxes on it right away. However, when he reaches retirement, he'll pay taxes on the withdrawals. But if Charlotte has been contributing to her Roth IRA, she won't owe any taxes when she withdraws her money in retirement. An incredible advantage if taxes rise over time. So what does all this mean for you? Well, the key takeaway here is that tax planning is an integral part of investing. Whether you're looking to minimize short-term capital gains taxes, maximize the tax efficiency of your dividends, or optimize your use of tax-advantaged accounts, the decisions you make can have a lasting impact on your returns. In fact, investing in tax-efficient ways could help you grow your wealth at a faster rate by minimizing your tax liability. It's not just about picking the right stocks. It's about understanding the tax rules that apply to your investments. What's the first step you'll take toward understanding your own tax implications of investing? Are you planning to hold investments longer for the better tax rate? Or are you exploring tax-advantaged accounts like Roth IRAs? Let us know in the comments below. Thanks for tuning in to Factful Finance. If you found this information helpful, why not like this video and subscribe so you don't miss out on more actionable tips that can help you achieve your financial goals. We think you'll enjoy the video that's showing on screen next. It's packed with insights that could give your investments a boost. Remember, finance doesn't have to be complicated. With the right knowledge, you can make your money work for you.